Welcome to RBC's Markets in Motion podcast, recorded December 1st, 2025. I'm Lori Calvasina, Head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. Today, we're tackling the year-ahead outlook for the S&P 500. The big things you need to know? First, our 12-month forward price target for the S&P 500 is 77.50, approximately the median and average of 5 different models that we use, which focus on sentiment valuation, the appeal of stocks versus bonds, the economic outlook, and monetary policy. Second, some of the key headwinds or downside risks, tailwinds and upside risks we're monitoring include shifts in expectations for the economic backdrop, renewed interest in geographical diversification, and the midterm elections. Third, tactically near term, we're leaning into the rotation in leadership within the U.S. equity market from growth to value and the mega-cap growth trade to the rest of the market, but caution that a shift in earnings dynamics is still needed for this transition to have significant duration. And fourth, we've gotten more comfortable adding to small caps, but see risk that recent outperformance ends up being short-lived once again, unless the underlying economic backdrop and overall economic conditions heat up significantly. If you'd like to hear more, here's another 7 minutes. Let's start with takeaway number 1. Looking out over the next 12 months, our S&P 500 price target is 77.50, implying a gain of nearly 14% from the pre-Thanksgiving close. As our regular listeners are well aware, we are all about the math when it comes to our target. 77.50 is an approximation of the median and average of 5 models that we're using. Here's a rundown of what they're signaling. On our sentiment model, net bulls on the AAII survey have been falling, hitting minus 9.4% on the 4-week average last week. That indicator is now between 1 and 2 standard deviations below the long-term average. Net bulls may have more room to drop near term, but current levels are consistent with a 15% 12-month forward return in the S&P 500. On our valuation model, our model projects a trailing PE for the S&P 500 at the end of 4Q26, based on consensus assumptions for CPI in the mid-2% range, several more cuts from the Fed, and 10-year yields around 4%. We marry that up with the bottom-up consensus trailing 4Q estimate of 311 for the S&P 500 over the same time frame. Our model points to almost 8,000 as fair value for the S&P 500, the most bullish signal from the 5 models we're using. On our stock versus bonds model, the earnings yield of the S&P 500 remains slightly below the 10-year Treasury yield, and the gap between the two is in a range typically followed by a gain in the S&P of more than 14% over the next 12 months. On our economic model, we look at how the S&P 500 performs on a 12-month time frame when real quarterly GDP on a year-over-year basis is in different ranges dating back to 1990. Both consensus and RBC economics are in the 1 to 2% range for 4Q26, which points to a 5.7% return in the S&P 500 or around 7,200, the least constructive of our 5 models. And on our Fed model, this is a new test in our toolkit. We look at how the S&P 500 performs on a 12-month time frame when Fed hikes or cuts are in certain ranges during a 12-month window. When cuts over a 12-month period come in between 0 and 100 basis points, the average return in the S&P 500 has been a little more than 13%. And one programming note, we have adjusted our methodology. Our 77.50 forecast is a 12-month forward price target, and going forward we will continue to update our price target on that time frame as opposed to a static December 31st number. In this context, some of our models have also been adjusted to reflect a rolling 12-month time frame as opposed to a calendar year. Going forward, we plan to update our 12-month price target monthly. Moving on to takeaway number 2, some of the key potential headwinds or downside risks and tailwinds or upside risks that we're monitoring. The first of these is the economy. If GDP comes in better than currently expected, our model indicates that the S&P 500 returns more than 10% on average when growth is in the 2 to 3% range, more in line, frankly, with our other models. By contrast, if GDP comes in well below expectations, our model reminds us that when growth is in the 0 to 1% range, the S&P 500 typically falls more than 9%. Another issue we're monitoring is interest in geographical diversification within equities. We think this headwind will persist. Flows have been strong to global ex-US funds this year and recently. Moreover, looking across global developed markets, earnings revisions have been stronger in the US but are fading from peak while recovering for Europe. Meanwhile, valuations are expensive across most major regions and countries in global developed markets, but look worse in the US by a significant margin. And the midterms. This is something we're watching. From the summer to mid-November, the S&P 500 was positively correlated with expectations Republicans will keep control of both chambers in the midterms. That expectation took a hit at the same time the S&P 500 experienced its 5.1% pullback. Next up, takeaway number 3. On positioning, we are tactically leaning into the rotation from growth in the biggest market cap names into value in the broader market. But think a shift in earnings growth leadership is needed for this to stick. The case for rotation is supported by AI jitters among both institutions and retail investors, along with a couple of the more popular charts in our deck. In these, we highlight how the performance of the top 10 names has returned to tech bubble highs relative to the rest of the market, and how the gap between top 10 names and the rest of the market on market cap share versus net income share is close to past highs. Additionally, flows favor value over growth within the U.S. on EPFR's data. Earnings are really the key, however, for the sustainability of a leadership rotation. We're still seeing slightly stronger EPS growth forecasts for the Mag 7 than the rest of the market. Earnings revisions are also still stronger on top 10 names in growth than the rest of the market in value, though their dominance is fading. Rotation is in the air right now and probably lasts a bit longer, but the tug of war between growth and value and top market cap names and everything else seems likely to return until earning dynamics really flip. And we'll wrap up with takeaway number 4. We have become more willing to add to small caps in the near term, but are not getting too comfortable yet. We see more positives for small caps than we did a few months back. Another rate cut rental trade seems to be picking up. On valuation, the next 12 months PE of the Russell 2000 is close to average. The Russell 2000 also has faster net income growth embedded in consensus forecasts for the next year, and the rate of upward EPS estimate revisions recently hit a new high for the Russell 2000, even though it's still well below past highs for the S&P 500. We also like the composition of the recent moves in small cap. There's been a higher quality bent to recent small cap performance. The Russell 2000 is not being propped up by the quantum stocks like we saw back in October. All that being said, there are some caveats. On the Fed, only a few more cuts are anticipated by our rate strategy team and consensus. Net income growth is expected to peak in 2Q26 in consensus estimates, and the lower PEs of the Russell 2000 versus the S&P 500 reflect a much lower ROE in small cap. Additionally, as we've highlighted before, to get a sustainable small cap leadership trade, we really need to see economic indicators like jobs growth and ISM manufacturing heat up. Historically, a very hot economy or recession rebound needs to be anticipated for small cap leadership to be sustainable, and that's just not what we're seeing right now. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.